Kamusta po sa inyong lahat? I'm Jason Ko, founder of Ko Planning Group. I've been a financial advisor and certified financial planner for almost 10 years now. Today, we're going to dive into the differences between investing in the stock market and physical rental property. We'll explore the pros and cons of each and help you decide which one might be right for you. In addition to closed captioning available in English, I also have it in simplified and traditional Chinese for my Chinese-speaking community. So let's get started. First, let's talk about the stock market. When you invest in a stock market, you're essentially buying shares in publicly traded companies. These companies can range from smaller niche companies to multinational corporations. There are a few key advantages and disadvantages to consider when investing in stocks. First, liquidity. You can quickly and easily sell your shares when you need cash. And if you have cash available, you can easily invest it as well. Whereas buying and selling rental properties could take months. Number two, diversification. When you invest in the stock market, you have the opportunity to diversify your investments across a variety of companies and industries. Since you're spreading your bets around, this can help reduce risk and potentially increase the chance of scoring a winning investment. This can be easily done with a low-cost ETF that invests in the global economy, like the Vanguard Total World Stock Market ETF with the ticker symbol VT. Number three, passive investing. When you invest in a stock market mutual fund or an ETF and you have a long-term strategy, you can get a pretty decent outcome by doing nothing. And you won't have to physically go anywhere to fix things or unplug a toilet just to earn returns from the stock market. Also, the effort to manage $1 million in stocks is about the same as 10,000. So it's scalable and you won't need to do any more work just because your portfolio has grown. Now let's move on to the disadvantages of stock market investing. Number one, volatility. Stock prices can go up and down rapidly. So this can lead to short-term fluctuations in your portfolio's value that can last from months to years before it recovers, and it can be very uncomfortable. Number two, liquidity. Getting in and out easily was mentioned as a benefit, but can also be a drawback for certain people. When Kramer and all of your friends on social media are telling you to sell because the economy is going into a recession, or everyone is telling you to buy a stock because it's going to the moon, it's very tempting and easy to trade now. And that will likely lead to losses because people as a whole tend to buy high and sell low. Now let's talk about investing in physical rental property. This involves buying a residential or commercial building and renting it out to tenants. Here are some advantages and disadvantages to consider when investing in rental properties. Number one, it's a tangible asset. A house is not a piece of paper and you can see it, touch it, and walk through it. The returns are easy to understand since you can get money every month from your tenant. This can provide a sense of security for some investors who think the stock market is just a big casino. Number two, leverage. When you invest in a rental property, you can put only 5 to 20% down to buy a property and pay off the loan over 30 years. This can potentially amplify your returns and allow you to start with a smaller sum of money. Number three, reliable income. Rental properties can generate a steady stream of income through monthly rent payments, and if it's managed well with long-term tenants, it can be pretty hassle-free. Number four, tax benefit. There are various tax benefits associated with rental property investing, such as deductions for mortgage interest, property tax, and depreciation, and when you eventually sell, you can defer your capital gains through a 1031 exchange. So if you walk into a room full of landlords, the conversation will invariably turn to the horror stories that they all faced. So let's talk about some of the disadvantages. Number one, illiquidity. Rental properties can take a longer time to sell than stocks. Also for me, it doesn't sit well to sell a rental while it is leased out, because in the end, it's still my tenant's home. So I've always waited until a property is vacant to sell and have missed out on certain opportunities because of that. Number two, concentrated risk. Unlike stock market investing, rental property investing tends to have more concentrated risk, as you're investing in a single property or location. If you have two rentals and one is vacant, 50% of your income just went away. If the whole industry your town is based on goes away, you end up like Detroit. Number three, it just takes work. Owning rental properties comes with a lot of responsibilities, such as finding tenants, handling maintenance, working with the city, flood in the basement, sewer backing up, and dealing with tenant issues. You can hire a property manager to take care of a lot of this, but they can't do everything for you. So there's always going to be work for you, especially when there is a vacancy and you have to deal with the city inspection, switching utilities back into your name, and making decisions on who will be your next tenant. Also, it is very hard to find a good property manager, and a bad one may cause more work for you than doing it yourself. Lucky for you, you can learn more about how I found a fantastic property manager in an earlier video. Number 4, it's hard to scale up. Managing one property might be doable, but 10 can be difficult for some people. The only reason why I find managing 9 properties easier now than the first one I bought is because I have spent years going through the frustration, building up the systems, workflows, and hiring the right people to help me manage at a bigger scale. So let's shift gears and talk about some examples of rental returns. We'll discuss one example where you bought a property for cash and another example with a mortgage with 20% down. And we'll compare that with the historical stock market returns. Here we have a property that's about $160,000 and rents out for $1,350 a month, which is about the going rate for the type of property I currently own in St. Louis. You can see after you factor in expenses like property tax, insurance, projected maintenance, property management, and lost rent from vacancy, out of the $1,350 in monthly rent, you are only netting about $746 a month, or $8,950 a year, which translates to an annualized yield, also known as your cap rate, of 5.6% on your initial investment of $160,000. Keep in mind, if you want to see your total return, you will factor in the price appreciation of the property itself. So if price growth is 4%, add that to your income yield of 5.6%, and you get a total return of 9.6%. Which is decently attractive if you're someone who values the stability and income of debt-free rental properties. In the second scenario, let's look at buying the same property, but with a mortgage with 20% down, 30 years to pay off, and with a prevailing interest rate of 6.75%. With a mortgage payment of $838 a month, now your net take-home income of $746 goes down to a loss of $91 a month, or $1,100 for the first year. For your initial investment, you only invested 20% of what you needed. And let's assume the seller paid for closing costs, so you had to put down $32,000 to buy the home. Divide the $1,100 of losses with $32,000 of initial investment, you get an annualized yield of negative 3.4%. Although that looks pretty bad, you have to factor in that you are still earning 4% of price growth on the entire property, which is an appreciation of $6,400, and you also got $1,417 of your mortgage paid down through the monthly payments. Your returns after factoring in your actual cash flow, your principal pay down, and price appreciation, your return now is about 21% for the first year. Interestingly, as more debt gets paid down over the years, the lower your return is because now you have more money locked up in a property that produces the same amount of cash flow and appreciation. And as rent rises over time, your cash flow might turn positive in future years. When you compare rental returns to a historical average of about 10% from the S&P 500 since 1926, some people, they may prefer to avoid the hassle of rentals and accept the returns of the stock market. But for some people, they may be more attracted to the higher potential returns of a leveraged rental investment and are willing to take the risk and do the work of being a landlord. So which investment is better for you? That depends on your personal circumstances, your preference, your financial goals, and your risk tolerance. When you buy a rental at a good price with moderate leverage applied and managed well, rental properties can provide significantly higher returns than the stock market. But if you are not ready to handle the responsibilities of a landlord, then consider the stock market instead. If you are uncomfortable with investing in the stock market yourself, then make sure to partner with a fee-only certified financial planner who can guide you through the ups and downs of the stock market. Now, I want to share my personal wealth journey with rentals and stocks to help you decide for yourself which may be a better fit. When I graduated college in 2013, I focused my time and effort on acquiring rental properties. It was the bottom of the real estate market, and rents I can get for the price I paid were extremely attractive. The cap rate that I can earn was much higher than the example that I gave earlier in the video, which was based on the value in 2023. In 2013, I was pretty young and ignorant, and I was obsessed with building up my own passive income streams, and investing in rentals was the route I chose to focus on. There were sacrifices I had to make, like I rarely went out with my new friends and coworkers despite repeated attempts by them to invite me out. I had to balance a new career as an engineering consultant with learning the ropes of being a landlord, and the low point throughout this whole time was during COVID, because in addition to balancing both my wife and my full-time work, taking care of an 8-month-old baby without any family support nearby while daycares were still shut down, I had to personally pick up the hammer for weeks at a time to help oversee a major renovation to our property because I had hired a bad contractor. Thankfully, all of my efforts in the past 10 years have paid off in the end, but it was very difficult, and I do regret not spending more time cultivating new friendships when everyone still didn't have kids, and getting into arguments with my wife due to extra stress. Although I had the bulk of my savings going towards buying more rental properties each year, my wife and I still made sure to invest in the stock market by maxing out our company's 401k match to get the free money, and to max out each of our Roth IRA contributions for the tax-free growth. After 10 years, most of our net worth growth did come from our rental properties, but I am definitely glad that I diversified into the stock market for the last 10 years as well. In my 20s, I spent a lot of time buying rental properties, but now that we've accumulated a decent net worth with a young child who only goes to daycare half day, and we're 10 years older, and I at times suffer from chronic back pain, my wife and I are more focused on my family and our physical and mental well-being. So at this point, my needs have changed, and I'm simply not as interested in buying any more rental properties. But what worked for me may not work for you. Ultimately, deciding between the stock market and investing in rental properties comes down to your personal preferences, your financial goals, and your risk tolerance. Both types of investments have their pros and cons, and there is no one-size-fits-all answer. Keep in mind too that you never have to make an all or nothing decision when it comes to money. Since you can easily divide money up, you can always put some money in rentals and some in the stock market. So that's a wrap on stock market versus rental property investing. By considering the factors we discussed today and hearing my personal story, I hope you can make an informed decision that best aligns with your financial objectives. If you found this information helpful, please like, share, and subscribe for more financial insights. Don't forget to leave your questions and comments down below, and I will personally answer them. So let's plan together. Sa alam po sa inyo lahat.